Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. Today I want to go over my 3 Canadian dividend stocks that I'm looking to watch in September. These are all amazing, solid companies that offer excellent growth and also excellent dividend returns. As you guys know, here on this channel, we like to focus on Canadian dividend investing as well as Canadian growth investing with things like ETFs as well as solid dividend plays, as there are some excellent deals out there in the market, especially for long-term dividend growth. Before I get to the 3 Canadian dividend stocks that I'm watching, I wanted to let you guys know that Wealthsimple is offering an amazing deal right now. As for simply signing up and using the platform, you get 3 times the referral sign-up bonus, valued all the way up to $4,500. And as you guys see here, someone recently won an Amazon stock fully valued at $4,400. So if you guys want the chance to use this platform and to get that return, remember to use the link in the description down below. With that said, you guys, let's get into the first Canadian dividend stock that I'm watching, which is Manulife. They're currently trading at $25.10. You can see that they have tanked over 50% down to about $12 per share during the March 2020 crash. They've slowly been increasing ever since, and their dividend is currently at $1.12 per share, which equates to 4.46%. A very quick overview of this company: Manulife is an insurance and financial service provider. They have many different streams of revenue like wealth and asset management, insurance and annuity products, as well as corporate revenues. They're quite diversified in their streams of income and are a very established player. One of their main businesses, insurance and annuity products, is a very steady and predictable stream of income, and with their revenues from here, they're able to invest in other markets to further capitalize on possible returns. They're quite diversified globally, with their business expanding not only to Canada, but the US as well as Asia, but they're mostly dominant in North America. Manulife failed terribly during the 2008 credit crisis, as their business model of using insurance premiums to invest in markets completely fell apart due to them being way over leveraged, and since then they have yet to been able to reach those previous highs. This has had a lot of investors neglecting it and putting it off, but with a near 5% dividend, I definitely think it should be on the radar, especially as since the financial crisis there are way more checks and balances in place to prevent companies from over leveraging to such extreme extents. When interest rates rise, and eventually they will, companies like Manulife, and in fact other companies in the same insurance space, will benefit a lot from those periods. So at the time, it is a tougher climate for the company, but that being said, in terms of valuation metrics, the company trades at a price to book ratio below 1. This means that the different divisions of the company like insurance, wealth management, and corporate management added up together are worth more than the current price of the company. So from a value approach to the stocks, this company looks like a very good deal at the moment. They're trading at 9 times earnings as well, so it's a very cheaply priced stock. They're not in any big financial burden. Their debt to equity ratio is low, and the debt to asset ratio is also low. So the financial health of the company is pretty strong. However, the company is not priced for a whole lot of growth. I mean, there are more exciting companies out there with much more growth potentials, but they don't necessarily pay the same amount of dividends that Manulife sees. And for those of you who are new to the channel, we like to focus on the juiciest of the juicy dividends, and Manulife is amazing with that, as they recently just increased their dividend by about 12%, which is one heck of an increase, as most companies raise their dividends maybe 3 to 4%, so a 12% increase is no joke. In terms of payout ratio, which just means how well the company pays out their dividends to shareholders, they're at a very steady at around 40%. And over the last 5 years, they've been growing their dividend just shy of 10% per year. So almost double-digit growth over the past 5 years, 12% growth last year. This company is paying out less than half of their earnings, which not only is very healthy and a reliable area to be at, it also shows that there's still room for growth in terms of their dividend. This means that as long as the company continues to do well, they will have a lot of room to increase their dividend. I do think that this will be the case going forward. There are a lot of varying opinions about Manulife. For example, some people may argue, why would I want a stock which doesn't show significant growth? It's kind of just treading water, and that outlook isn't very massive. However, if your approach to the company from an income perspective based on the metrics I've shared with you, it is a very good opportunity. If the company can continue to grow well in their core areas, and their core areas, as you can see, include Asia, which Manulife has a pretty strong presence in, Canada and the US are also very strong markets. As long as they can continue to grow their earnings in these core areas, the more emphasis they can put on growing their dividend. If you were to go out and buy this stock today, you would be earning a 4.46% starting yield, which we have shown that the company has the net income to cover very easily. So on top of that, if the company is able to bump the dividend year after year with double-digit growth, which is what we have seen, the income and dividend potential shows that it is a very solid dividend play. I think this company deserves a bit more credit than it gets, considering the valuation metrics I've shared with you. I think Manulife is one of the top and one of the better dividend paying stocks in Canada, and it is definitely something that I'm considering adding to my portfolio. This is a definitely company to have on your radar, especially if you're looking for that sweet passive income, as it offers an amazing dividend and the company is very solid, especially foundationally here in Canada and in the US. The second stock that I'm watching is Royal Bank of Canada, ticker symbol RY. This stock is an iconic Canadian name that needs no introduction. At the time of recording this video, it is the largest Canadian public traded company on the TSX. The stock is up 20% on a year-to-date basis. Even though it is up so high, I still think it is a buy with much more upside. As a dividend growth investor, there's a few fundamental things that we want to consider when looking at a company, one of them being consistent dividends. Due to the COVID-19 impact, many companies were forced to cut their dividends, but RBC did not. And after reporting its Q2 2021 results, it has more than $10 billion in excess capital, and this is going to be used to increase their dividend very soon, and you can bank on that. It is currently trading at $132, has a market cap of $188 billion, a PE ratio of 12.47, and a dividend return of 3.27%. It pays out dividends on a quarterly basis in January, April, July, and October of each year. Looking at RBC's year-over-year growth, we see triple-digit growth in net income, earnings per share, and operating income, 56% and 73% increases in revenue and profit margin. This is a big corporation that makes big money for its shareholders. RBC can leverage its scale, has amazing capital management, and has a diversified business mix to drive long-term growth. Despite the huge run following the 2020 lows, looking at the analytics recommendations, RBC is not a mix between a buy and a hold, it is simply just a buy. If we take a look at the price target, the current share price is still below the average price target. There's still much upside to be had. The highest price target is $145 per share by analysts. Needless to say, there's still much more upside just this year. RBC has recently launched a brand new innovation hub in Calgary with plans to expand technology roles in high demand areas. This just goes to show that even with the huge size of RBC, they're still looking to grow and they have a focus on high growth areas. RBC is not only Canada's largest bank, but also one of the largest banks in the world based on market capitalization, and they have a very well diversified business model with their focus on innovation and growth. RBC is an ideal holding for long-term investors. It has an amazing track record. It was here long before us and most likely will be here after we're gone. In my opinion, it's a guaranteed cash mark and definitely a company I want to add in my long-term portfolio. Now that Wealthsimple offers fractional shares, it is very easy to get in on investing, as you can buy stocks like this that are valued at $100, $200 for the price of even $1. That gives you a portion of the share, which means that for even a little amount of money, you can get in on investing. And if you guys are looking for that, there's a link down in the description that tells you how you can do that as well. The third and final company that I want to go over is Canadian Pacific Railway. This is a freight railway company that currently has rail systems established in Canada and through the US. They transport basically everything from agriculture to automobiles. One reason I really like this company is because it offers extreme stability, as entering the freight rail industry is extremely difficult due to the high barrier to entry. For someone to start a rail company, they would first have to establish a rail ecosystem through major ports, which take decades to get approved. On top of that, the high cost to actually build the entire rail system. For this reason, there are only two main companies in all of Canada that have rail systems, and that's Canadian National Railway and Canadian Pacific Railway. CP Rail is currently seeing record growth as seen in their recent earnings reports, and on top of that, their dividend has been growing at an amazing 20% per year over the last 5 years. Recently, there has been a lot of drama between CNR and CP, as they both have been fighting to buy Kansas City Southern, which is a rail company in the US. Both companies have been bidding crazy numbers to buy KCS, as it will allow whoever buys them a rail system that goes from Canada, the US, all the way through to Mexico, making the company have extreme access to ports all over North America. Up until recently, it looked as if CNR was going to win the bid to acquire KCS, as they put up the higher valued offer for the company and CP simply couldn't match them. However, just recently, regulators have actually cancelled CNR's deal, which opens the door for CP, and it now looks as if CP will have the winning bid. Looking at both company stock prices here, you can see that CNR has actually shot up since the news broke that they were losing the deal. This has to do with the fact that major shareholders of the company have urged the board to not go through with the deal, as they fear that they are way overpaying for the company and the return that they're getting does not justify the extremely high cost to acquire the company. For me personally, I think that the purchase of KCS will work out very well for whoever ends up acquiring them. This is because that in the long run, the moat or the barrier to entry into the industry will only continue to grow, and if they have to pay more now to have the ability to carry goods across the entire continent, I believe that they definitely should do it. However, in the short term, I definitely understand why shareholders feel as if it is a bad deal, as even after KCS has shot up massively on rumors that they were being bought out, both CP and CNR are paying billions over market value for the company. And if we look at the inherent value of KCS before they shot up, we see that both companies are way overpaying. For me, investing in both companies seems to be a win-win, as I can now buy CP at quite a big discount and currently hold CNR at a very solid cost basis. So either way, I believe I'll come out on top as a shareholder. Whoever loses the bid will see short-term success, and whoever wins the bid will see a discount, and I can buy into a very fundamentally solid business at a steep discount. For this reason, CP right now looks like a great buy for long-term investors, as you're getting a solid deal for a company that in the long run will continue to see amazing growth. As you guys may know, I am currently an investor in their main rival, Canadian National Railway, and I have a bunch of videos going over that I will leave in the description down below. And if you guys are looking to see my entire portfolio holdings here on Wealthsimple, I'll also leave a link going over my entire portfolio. With that said, thank you guys so much for watching all the way through to the end, and if you found any value whatsoever, remember to hit that like button down below, as it really does help the channel to grow, and also consider subscribing for more investing videos like this to come. Have a great day, guys.